Good afternoon. My name is Greg Boland, Chief Strategy Officer of Tiger Brokers. It's my great pleasure today to welcome Cameron McCormack from VanEck in Australia, who's a Senior Portfolio Manager, and he's been there at VanEck for 7 years or so. So the format of today is that we'll ask first questions on the way through, and Cameron will explain where do we grow from here, which is a very interesting heading, given the volatility we've seen in global markets, particularly over the first part of this year, and definitely from Liberation Day. And some people, said in humour, perhaps, that it was obliteration day rather than liberation day. So markets have been very volatile since that time, and it's interesting to get a perspective from one of the leading ETF providers in Australia as to where they see things are happening at the moment and where the markets are going to go. So the format today is Cameron will go through various slides and introduce different parts of the discussion. And you're very welcome to send questions through to the chat box, and we'll monitor those and answer those at the end of the session if there's time. So we've got about an hour, and very much looking forward to what Cameron has to say. So Cameron, maybe you'd like to give us a little bit of a background on yourself as well, if that would be possible.
Thanks, Greg, for the introduction, and thanks to Tiger Brokers for the invitation to speak to you all today. Greg gave a good introduction of myself. I'm the Senior Portfolio Manager at VanEck. In terms of my sort of remit in the team, it's primarily focusing, we've just launched an alpha ETF, long-short Australian equities ETF. So I'm one of the lead portfolio managers on that one. And I also am the lead portfolio manager on our fixed income ETFs as well. So quite broad ranging. So for those that aren't, or just before I get into the presentation, just a quick reminder that what I am presenting today is of general nature and does not constitute personal advice. So for those of you that aren't familiar with VanEck, we're a global investment manager established in 1955, and we manage around $200 billion in assets in Australian dollar terms. Now, globally, we're really considered leaders, pioneers in gold and gold equity investing. We have the largest gold equity ETF listed on the New York Stock Exchange. It's in the top 15 most traded instruments in that market, which is quite remarkable. But when it comes to Australia, we offer 45 ETFs, manage around $23 billion in Australian dollar terms. And in terms of our offerings, it's really two key things in terms of how we differentiate ourselves. First one is bringing beyond the usual approaches to asset classes. In particular, say for smart beta investing, we have Australia's largest international quality ETF, the ticker's Qual, and we also have Australia's, only Australian equal weight ETF as well. Only ticker is MBW. Those two have been around for more than 10 years. So that's the first component. And then the second component is bringing to market asset classes that we think are underrepresented in Australian investment portfolios. A few to think about would be global small caps, typically underrepresented and have done quite well over the medium to long term, and emerging market bonds as well. So quite nuanced, markets, and really broad ranging in terms of the offerings we bring to market.
Cool, thanks, Cameron. So in terms of global markets, maybe you could like to set the scene as to what you think's happening and what you're seeing in terms of global markets at the moment.
Yeah, it's certainly been a very interesting period, even over the last sort of six weeks or so, particularly since the onset of, US Liberation Day. And we know that, Trump came out with a broad-ranging announced, range of tariffs, essentially on all the, countries that do export to the US market. Since that period, market volatility has somewhat slided. And at the moment, we've seen a bit of a market rally. And the question is, where to from here, and is this sustainable? But really, the overall backdrop, because of this uncertainty around tariffs and how it's going to impact markets, is that stagflation fears have risen. So what I mean by stagflation, it's really two components. The first one is that the market's now pricing in lower growth expectations, and also higher inflation expectations. And that's certainly not what you want, both from a monetary perspective, but also from a fiscal perspective. And this is really highlighted on the two charts. So the left one's looking at US real GDP on a quarter-on-quarter basis. And you can see for Q1 this year, it was actually negative. And this has also raised, I guess, fears of a recession, which is technically 2 consecutive quarters of negative GDP growth. The second component that's playing out is that we've seen inflation expectations increase, primarily on the back of the uncertainty around tariffs. We know that, I guess, tariffs are inflationary in nature, and this is highlighted when you look at the teal color, showing the change in forward-looking inflation expectations in the US. On the flip side, because of this uncertainty, consumer sentiment has also come off as well, and you can see that in the dark blue line. Now, because of this uncertainty around how tariffs are going to impact, broadly speaking, the global economy, it's also had an impact on manufacturing activity. And what we have on screen is, in the teal color, US manufacturing activity. So that's the ISM manufacturing index against US business conditions in terms of their outlook on a forward-looking basis. And you can see that, broadly speaking, there's a positive correlation between the two, and that makes sense. Now, what you can see, if you look at the far right-hand side of the chart, is that the teal line, so manufacturing activity, has actually gone from expansionary to contractionary in the last few months because of that uncertainty. And you can see that as well, business conditions have also come off. So it really, I guess, reinforces the uncertainty, or I guess the uncertain environment that we're in at the moment.
Cool. So the market's been pretty volatile, obviously. So, if we look at things like the VIX, which is a measure of volatility, the CBOE volatility index, it spiked as high as above 60 in April. So what's happening since, and where do you think it may head in the next 6 months in terms of volatility?
Yeah, it's a great point of reference. And what we have here on screen are the Z scores for the equity volatility index, so the VIX index, versus the US economic policy uncertainty index in the dark blue line. Now, when you look at previous episodes where you did see a spike in market volatility, what you can see is that it generally took more than 12 months to get back to normal levels on a consistent basis. And this framework says to us that, and given, I guess, if you think about sort of Trump's, I guess, brash nature, is that we do think, unfortunately, market volatility is likely to persist at least until the end of the year. Now, having said all this, if you look at the US labour market, it is quite resilient despite this uncertainty, and there's a range of metrics to really reflect on. The first one is, if you look at US unemployment rate, it's around 4%. And it's below its, I guess, Nauru rate. So that's the non-accelerating rate of unemployment. So it just means that there's going to be underlying pressure on services, particularly services inflation, because it's very heavily linked to the strength of the labour market. The second component is that we're seeing job openings come off, and they're sort of at, I guess, more normal levels. And this is just a reflection of a bit of loosening in the market, but it's not to the extent that we're seeing, I guess, layoffs. So, the job opportunities out there is a lot more deflated. And you can certainly see that in the US crude rates as well. So it's just saying that people are less inclined to change jobs because of that uncertainty. So we've seen a little bit of softening in the market, in the labour market, but it's still quite resilient on a headline basis.
In terms of Trump's, he sort of backstepped a lot in April because of the bond markets and yields and the like, and there's a lot of stress from or potential stress from this tax bill where the fiscal deficit might increase by another $4 trillion on top of the 37 odd trillion it already is. So, if the debt goes up by another 10 or 11%, it's a huge change in the fiscal deficit of the US. So how do you see that in terms of fiscal uncertainty and the like?
Yeah, there's a lot of it's certainly getting a lot of attention in terms of the debt outlook for the US, and that's also another reason why we're seeing, I guess, stagflation fears, bubble. And is also why, when you think of the long end of the curve, so looking at the US 10-year and the Australian 10-year, why it's quite elevated relative to current levels because of that uncertainty about how the US is actually going to service its debt. And this is really highlighted when we look at, I guess, the range of charts on screen. So the first one's just looking at the change in the US budget deficits. You can see it's continually, I guess, getting worse. And if you look at the federal government debt relative to GDP, it's sitting at around 120% and is expected to sort of stay at that level for the foreseeable future. Now, when we think about some of the range of, I guess, policy developments we've seen, what Trump's initially, well, I guess, primarily trying to do is use tariffs as a way to improve the budget balance for the government, and in doing so, allowing the government to implement tax cuts through the beautiful big bill that's currently in the works at the moment. So on a net basis, the challenge is that, unfortunately, I guess US government debt is likely to continue to remain elevated, and is why it's just compounding the uncertainty we're seeing at the moment. And you can see if you look at the right, US outstanding public debt just continues to climb, and it's close to reaching again the ceilings.
Okay.
There's certainly a lot of talk about, I guess, inflation expectations coming back. We haven't necessarily seen that come through in concrete numbers. And one interesting area to watch closely is looking at changes in commodity prices, because they have been quite a strong leading indicator for headline inflation in the US. And this is shown in the chart as well. So the dark blue line is looking at US inflation on a year-on-year basis, and the teal color is looking at the change in commodity prices on a year-on-year basis. So you can again see that positive correlation coming through. So if we start to see commodity prices increase, that could be a signal that inflation is actually coming through. So at the moment, we haven't seen that.
Okay. And then in terms of individual stocks in the US, we've seen, the Q1 reporting is just all but over. I think Nvidia is one of the last major ones this week. So how have you seen the first quarter reporting? So it started, early April with the major banks and some of the tech and retailers more lately. So how do you see the earnings season playing, or how has it played out for this Q1?
Yeah. So broadly speaking, it's been quite positive. If you look at the beats, they've outweighed misses quite considerably, and this is reflecting on Q1 data. So despite the uncertainty around tariffs, if you look at the underlying fundamentals of a range of companies in the US, they've been quite resilient, which is quite positive. And I think it's also one of the reasons why we're seeing equity markets bounce back quite quickly. In terms of some of the surprises coming through, Consumer Communication Services has reported quite strong net beats, materials as well, which is quite interesting, and also industrials. Whereas if you look at, say, consumer discretionary, they're probably one of the outliers that did report more net beats. And some of the, I guess, themes coming through is that despite the uncertainty around tariffs, business balance sheets have been quite resilient across the board. But having said that, a lot of them actually removed their forward guidance because of that dynamic playing out. Pleasingly, if you look at the Mag 7, the earnings results have been quite resilient. Microsoft in particular reported earnings that came in at the top of analyst expectations. And this is on the back of continual demand for companies looking to expand their AI capabilities. What's interesting as well is if you look at consumer spending numbers in terms of subscriptions across Disney and Netflix, they've also been quite resilient. So clearly, US consumers are still, spending money despite that backdrop.
Okay.
In terms of some of the sectors and styles, in terms of how they've come through, value has reported on a forward-looking basis. Analysts see more potential further upside. And we know that value companies year to date have outperformed the broader benchmark, but also growth in particular, and also quality. So that's something to watch out for. But having said that, the results in terms of the price targets have dialed back to a degree.
Yeah, I find it astounding how boards and CEOs can actually give any forward guidance when there's so much uncertainty around these tariffs and various bits and pieces. So for these CEOs to actually give guidance is astounding, I think.
It is, and you would have seen even in the last sort of 20 to 48 hours, Trump put out a tweet saying that Apple needs to move all their manufacturing to the US. They can't move. They shouldn't be moving it to China. So it's it's a difficult in terms of some of the big tech names in particular. How they navigate these dynamics unfolding.
Yeah, it's definitely very difficult. And in Australia, what are you seeing in Australia at the moment?
Yeah, so early signs are quite positive. We did see Q1 GDP, sorry, end of Q4 GDP numbers come out quite recently. And the positive is that economic growth seems to be improving despite, I guess, the uncertainty playing out. Now, a key barometer to be watching in particular is looking at Australia's trade balance. If we're seeing more exports than imports quite considerably, that's typically positive for economic growth. So if we do see, I guess, an improvement in commodities demand, particularly from China, for example, that would certainly be a tailwind for the Australian economy. And that's not necessarily priced in at the moment. We know that, say, financials, in particular the big four banks, have outperformed resources recently. Now, one of the interesting points is that we've seen, obviously, the RBA commence its easing cycle. They did decrease the cash rate by 25 basis points just recently. And one of the catalysts for that doing so is that if you look at the dynamics in terms of inflation on a quarterly annualized basis, they're heading in the right direction. So you can see that in particular, the true mean in the dark blue is within the 2 to 3% band, which is ultimately the key focus for the RBA. So stripping up more of the volatile items, making sure that the core inflationary indicators coming through are in a reasonable band. Having said that, if you look at services inflation, which is in the purple color, it's still above that 3% range. And that's just a function of the underlying strength of the labour market that we're seeing at the moment as well. And this is also, I guess, a key reason why we do think that a shallow easing cycle is more likely in Australia. And there's a few reasons for this. If you look at business input costs on a year-on-year basis, this is shown on the left-hand side, it's sitting around 4%. So because of those high costs, they're going to have to pass it on to consumers, and naturally it's just going to put elevated pressure on those metrics. Similar to the US, the labour market's quite resilient. The unemployment rate's at about 4%. So that's going to continue to put upward pressure on particular services inflation. And one of the positives as well is that we've started to see a rebound in retail sales on a year-on-year basis. And this is shown in the dark blue line on the right-hand side. You can see there's an incremental increase in that. And again, that just reinforces that if you look at the Australian economy, it's still quite resilient. It reinforces our expectations of a shallow easing cycle, despite, I guess, the backdrop of tariffs. Now, having said that, Michelle Bullock did, I guess, give more of a downbeat guidance in most recent update. They did consider actually cutting the cash rate by 50 basis points. So it's certainly going to be a wait and see scenario for the foreseeable future. So to summarize on our macro views, we do think that market volatility is likely to persist. If you look at previous episodes where you did see spikes, it took a considerable period for it to unwind. Certainly the ongoing discussions around tariffs and trade deals will naturally, prop up volatility. The risk of US disinflation stalling is certainly quite elevated, given the underlying strength of the labour market and certainly the outlook for government debt and also tariffs. Having said all this, we do think that the risk of a US recession appears low. But having said that, if we do see a continued falling confidence, that can be self-fulfilling. And finally, in Australia, we do anticipate a more shallow easing cycle in Australia. We're thinking more 1 to 2 more rate cuts before the end of the year.
Okay, cool. So you guys at VanEck offer a range of ETFs, and so given this sort of macro background, What sort of investment ideas have you got for us and can share with us today? It'd be good to know what you're thinking in terms of forward-looking view on the situation.
Yeah, so for the rest of the presentation, I'm going to go through three key ideas. The first one is quality investing, and this is certainly an area that typically outperforms in a lower growth and heightened market volatility environment. So certainly, I guess if you think about the backdrop that we're in at the moment, it could be an area that could be quite pronounced going forward. So quickly, just in terms of quality investing, we do offer Australia's largest quality ETF in the market. Qual, in terms of AUM, is around $7 billion. It has a more than 10-year track record. The management fee is about 40 basis points, and over that time frame, it has outperformed the benchmark, being the MSCI World ex Australia Index. We also offer a hedge version. The ticker is QHAL. Management fee is 43 basis points. It's been around since 2019. So when we think about quality investing, it's really giving you exposure to the defensive characteristics of the market. And this is really highlighted when you look at the chart on screen. So what we have is the VIX index, the equity market volatility index in the dark blue line, versus the cumulative relative performance of quality versus MSCI World ex Australia. And what you can see is that when we do see heightened market volatility, so the VIX index spiking, that's typically when quality companies outperform. You can see that coming through during the global financial crisis, the dot-com bubble, and during the US-China trade wars back in 2018, 2019 in that teal color, and also during COVID-19. And we also saw it during the brief spike in the VIX index during the early part of April as well. Now, one of the interesting observations is that when you also look at the cumulative relative performance of quality versus the benchmark, and then compare that to the US ISM manufacturing index, it also reinforces the defensive characteristics coming through. So what we have is the ISM manufacturing index, which is a great proxy for economic activity, broken up into 4 quadrants. So the first one is in the green, so periods of expansion. The yellow one is looking at periods of slowdown. The purple is looking at periods of contraction, and the blue is looking at periods of recoveries. And what you can see generally is that quality outperforms in 3 out of the 4 phases. So in the early parts of the recovery, during the slowdown in the yellow, and also during a contraction period. And because of manufacturing activity being quite subdued over the last sort of 2 to 3 years, quality has actually outperformed during that environment. Now, when we think about quality investing, it in terms of how we think about it relative to value. So value is outperforming, typically quality underperforms, but not to the extent that, say, growth underperforms. And we saw that in 2022 during the quite strong value rotation. Now, the key driver of that, and this is shown when you look at the cumulative performance on the left, is that during this period, inflation was increasing, and naturally central banks had to push through rate hikes to try and tame inflation. Now, because of the longer duration elements of quality investing, they were more, I guess, adversely impacted, but not to the extent of growth. Now, when we saw a growth rotation play out, we saw quality outperform. So it really, I guess, reinforces the defensive characteristics, but also the potential upside capture as well, from a more factor standpoint. So in terms of quality investing, this is our snapshot for our global small caps ETF. So in terms of what I mean by quality investing, it's looking for companies with 3 key fundamentals: high return on equity, low financial leverage, and stable year-on-year earnings growth. For Qual, it's targeting companies with the strongest, well, the 300 companies with the highest metrics in those 3 areas. So and this is the snapshot for our global small caps ETF. The ticker is QSML. In terms of AUM, it's about 1.5 billion. It invests in 150 quality global small caps and has been around since 2021. Now, there's a few reasons why we think global small caps could be back into favour. The first one is that if you look at previous episodes where you saw periods of quite prolonged market recoveries, that's typically when small caps outperform. And you saw that between the .com GFC, post the GFC, during, I guess, various other market rallies. Now, one of the exceptions to that has obviously been the rally that we've seen really since the middle of 2022. And the primary driver of that has been the strengths of the Magnificent Seven. Now, having said that, if you look at valuations, in particular of large caps relative to small caps, because of this dynamic, we could start to see small caps outperform if the market rally continues.
Okay.
And this, oh, sorry, Greg.
No, that's fine. You're just saying okay.
Oh, good. Yeah. What we have is the valuations for global small caps on the left-hand side. And you can see that they're actually trading below the historical average, whereas large caps are trading, because of the recent rally we've seen, are trading above the historical average and close to quite, I guess, somewhat extreme levels. And if you look at the differential between large cap valuations versus small caps, they're actually trading at a 25-year low. So we do start to see valuations become more, I guess, important. That could be another catalyst for small caps generally. Now, when it comes to global small caps, there's around 4,000 companies in the universe. It's certainly quite wide-ranging. In terms of the market caps themselves, when you think about it in the context of Australia, it's really investing in, I guess, mid caps. So companies that would be ranked on the ASX from, say, stock 20 to about 100. Now, having said that, what we have seen is we've seen a gradual increase in unprofitable small cap companies, and this is showing the change year on year for the Russell 2000. So that you're looking at US small caps, and it's at the moment about 40% of companies are actually unprofitable. Now, we think this is really important to be selective for that primary reason, in that if we do see, I guess, valuations become under the spotlight, certainly having a quality overlay makes sense because of the defensive characteristics that investing in quality companies offers you. If you look at, I guess, a range of academic research, what's also interesting is that if you look for companies with quality characteristics in the small caps universe versus the large cap universe, they were shown to have delivered higher alpha. Now, a key reason for this is that if you think about small caps, they're typically underrepresented from analysts in terms of sell side coverage. So there's more opportunities to exploit price discovery. And that's a primary, I guess, again, another reason why we think looking at global small caps from a quality sleeve makes sense as well. So the second theme I'm going to touch on is gold and gold miners. Now, certainly with the heightened geopolitical environment that we're in, despite the rally that we've seen of late, gold and gold miners have been in the top best asset class performers year to date. There could be further upside to this structural trend.
Definitely been one of the most popular hedges against this the market volatility this year, that's for sure.
Yeah, certainly. And if you look at the gold price in US dollar terms, it's rallied to above 3,300, which is quite remarkable. And certainly from our perspective, there could be further upside to this playing out. So in terms of gaining exposure to gold and gold miners, we offer gold bullion ETF. The ticker is NUG, which I quite like. Now, the key differentiator for our offering is that only invests in gold that's stored at the Perth Mint, whereas some of the other offerings out there provide exposure to gold stored in the London Vault. Now, some of those other ones, they give you exposure to gold that have been sourced from all around the world, so including the likes of, say, Russia, whereas ours only invests in gold sourced from Australia that is stored at the Perth Mint. The management fee is 25 basis points. AUM is about 140 million. and it's been around since the end of 2022. In terms of gold miners, the ticker is GDX. In the US, we offer, it's one of our largest ETFs in that space. As I said earlier, it's in the top 15 most traded ETFs in the market. In Australia, our offering is about $700 million. The management fee is 53 basis points, and it's giving you pure exposure to gold miners, global gold miners.
I traded that one a lot for clients before, and when I was a broker, so the old GDX.
Yeah,
very popular with retail traders, particularly using the actual stock or the options on that GDX.
Yeah, it's certainly quite volatile, but I guess there is a place for it, and this is, I guess, reinforced when we look at the long-term performance, particularly when we look at gold versus some of the asset classes. So what we have on the left is the 15-year performance versus risk profile of a range of key asset classes, and you can see, I guess, gold is quite an outlier when you look at volatility. Now, that's not necessarily a bad thing when you think about it in the overall context of an overall portfolio. One of the key benefits of gold is that it has a very low correlation with other asset classes, and that's shown on the right-hand side. So if you include gold as part of an overall portfolio mix, it has shown historically to improve your returns for targeting the same risk profile. So if you're looking at targeting, a market volatility of 6%, the incremental additive value of including gold had improved that by 0.5% on an annualized basis. One of the other aspects that gold could have further legs to run is certainly with inflation expectations increasing. This is typically an environment where gold has outperformed, and this was shown during the second half of the 1970s, during the middle of 2000s, where we saw a resurgence in inflation, and during the second half of 2022 and 2023 as well. One of the key reasons why gold has continued to rally has been the demand from central banks, particularly from emerging markets. And what you can see is the net purchases of central banks on a year-on-year basis on screen. And there's been persistent buying for really the last 15 years. And we've actually seen a tick up in the last 2 to 3 years because emerging markets, because of this uncertainty around diversifying their reliance on the US dollar, they're seeing gold as a natural void to fulfilling that gap. Now, in terms of gold and gold miners have, over the last 10 years, have underperformed gold, despite typically giving more leveraged exposure to gold. So what I mean by that is because when you see gold rally, typically gold miners rally more because of the underlying impact that increases in gold prices have on the balance sheets of the underlying gold miners. Now, despite this, if you look at the intrinsic value of the gold miners, they're actually trading at a 20% discount despite the market rally we've seen of late. So there could be further upside, particularly if you see this value rotation play out. And this is shown in the dark blue line on a historical basis in terms of that premium discount to gold. So one of the other reasons why we like gold miners in particular is that their balance sheets have improved over the last 10 to 15 years. On the left, we have the change in gold price in the teal color versus the change in all-in sustaining costs in the purple bar charts. And you can see that there's been an increasing dispersion between the two. So what this means is that profit margins of the gold miners have improved. On top of this, free flow cash margins have improved, and their net debt to cash flow have improved starkly over the medium to long term. So again, this just reinforces the underlying strength of the balance sheets of a range of gold miners, or global gold miners in the market.
Very good. Okay, so in terms of, we looked at the first companies and then gold, but also emerging markets. They're often an afterthought So gold sometimes a bit of an afterthought as well, but I think more people are looking at gold. But emerging markets seem to be an afterthought in a balanced portfolio. So why should this market be looked at as important, and how can we gain exposure to it?
Yep. So emerging markets have been getting a lot more focus, particularly over the last few months, primarily on the back of some of the USD weakness that we've seen played out. Now, what we typically see is that emerging markets outperform developed markets when you see, I guess, the US dollar underperform. We did see this between the dot-com and global financial crisis. And because we've seen, I guess, primarily apart from the last sort of few weeks, US dollar strength, it's been a key reason why emerging markets have been generally out of favor. So in terms of gaining exposure to emerging market equities, we offer a diversified multi-factor strategy. And what it's looking to do is find companies with 4 key characteristics: value characteristics, low size, momentum, and quality characteristics. And in terms of our offering, the AUM is around $225 million. The management fee is 69 basis points. And the key premise for why we took a multi-factor approach when it came to emerging markets versus, say, developed markets, which just focuses on quality companies, really comes down to 2 things. The first one, if you think about emerging markets, what China's doing does not necessarily correlate to, say, what Brazil's doing or what India's doing. They operate in quite strong silos. So what I mean by this is that I talked about quality investing earlier, and we know that it typically outperforms in low growth and low inflation environments. And when you think about developed markets, if the US is doing well, typically Europe's doing well, typically Australia's doing well. So it makes sense in terms of trying to time factors in terms of, say, quality investing. But when it comes to emerging markets, there's a lot more divergence in terms of what's happening in the underlying economies. So this is the primary reason why we took a multi-factor approach, because that's quite strong divergence. In terms of why, sorry.
So just a quick question on that. So you've got 230 odd companies. Is there, do you sort of have a maximum limit on each country or anything like that, or is it just that whole global universe and look at the best ones?
Yeah, so we've got a range of, I guess, risk parameters that are assessed when we do the semi-annual rebalance. Now, generally speaking, the multi-factor ETF is country neutral. And this is important because, and I talked about this earlier, is that if, say, China is outperforming, Brazil may not necessarily outperforming as well. So taking a country neutral approach makes sense rather than having, I guess, quite strong country bets and trying to extrapolate, I guess, some of the underlying strength of taking the multi-factor approach.
Okay, cool. Thank you.
I touched on this earlier. So what we've seen, because of the uncertain, I guess, because of stagflation fears building in the US, this has resulted in USD weakness over the last few weeks, and has been one of the key reasons why emerging markets year to date has outperformed developed markets. So if we do see, I guess, a prolonged, say, value rotation, emerging markets could come back into favor. And if you think about emerging markets, broadly speaking, they typically deliver a high level of real GDP growth versus developed markets because of they're still in that infancy stage. And if you look at, I guess, emerging markets over the long term, they have typically outperformed developed markets as well. So if we do see that structural change in macro dynamics, it could bring it back into favor. One of the other reasons why emerging markets is quite compelling comes back to valuation. So we have price to forward earnings for developed markets and emerging markets on the left versus price to book on the right-hand side. You can see that if you look at developed markets in the black, because of the market rally we've seen, they're quite elevated. Whereas if you look at, say, emerging markets, they're sitting around their historical average, and on a differential basis, they're again sitting at close to 25-year lows as well. So it's another area that we think could come back into favor, particularly if we do see this, say, value rotation play out. In terms of the lure of EM, the potential for growth in that they typically deliver high real GDP growth compared to developed markets. They also offer diversification for an investment portfolio. In terms of the drivers, they're quite nuanced compared to developed markets. And certainly when you look at valuations, they're looking quite compelling relative to developed markets as well. Now, one of the, I guess, key challenges with emerging markets is that if you look at the median active manager returns on a historical basis, is that there's been quite high dispersions, but generally speaking, they've actually underperformed over that time period. So in 10 out of the last 14 years, the average active manager has underperformed the benchmark. And that, from our perspective, we think that certainly taking a more systematic approach makes sense. I touched on this earlier in terms of why we took the multi-factor approach. MSCI research found that doing a bottom-up approach to find companies with quality characteristics, value characteristics, momentum and size had shown to deliver high Sharpe and information ratios compared to taking a top-down approach. So, for instance, taking a basket of quality companies and then equating to, say, a basket of value companies and so forth. They also found that those four combinations were also delivered the most optimal information and Sharpe ratios relative to other combinations. So, for example, just looking at, say, quality and value, or just quality and low size. If you look at NKT's index over the long term relative to the benchmark, it has outperformed over that period, and since ETF inception, it has outperformed the benchmark as well. So this concludes the presentation. I'm happy to pass on to the audience for questions.
Thanks very much, Cameron. Excellent overview of what's happening, and we've got a few questions from our audience today, which is pleasing. So first one is from obviously a young investor. So for young investors in Australia or those who are just starting to manage their finances, what practical investment methods do you think are available in a volatile market?
Yeah, it's a great question. I think a key reference point is certainly the 60-40 portfolio. So looking at, hypothetically, having 60% in equities and then potentially 40% in bonds. Now, what you typically see in periods of market volatility is that if equity markets come off, typically bond yields also come off. So because of that dynamic, because of that negative correlation that comes through, it's a way to, I guess, indirectly give you defensive characteristics from looking at, I guess, bonds in particular. It's quite an, I guess, it certainly depends on, I guess, your individual sort of, financial circumstances, but it's certainly, I guess, a key reference point to think about. We're strong advocates, certainly, of quality investing when it comes to international equities exposure, and they have shown during periods of market drawdowns to typically outperform and also recover faster as well.
Well, thank you. Excellent question, that one. So the second question is, how has multi-factor stock selection strategy adopted by EMKT performed during the past volatile periods or during past volatile periods? And are there any practical examples to share?
Yeah, it's a great question. So in terms of NKT, it has outperformed over 1, 3, and 5 years since its inception. In terms of, I guess, broadly speaking, it's a quite a considered way to gain exposure to emerging markets. And when you look at some of the underlying, I guess, drivers, it's been quite different to, say, developed markets, in that we have actually seen, say, value outperform in emerging markets, and that's been a key catalyst for driving some of the outperformance that we've seen from emerging markets, or from, EMKT in particular.
Thank you. And one further one is, what do you think of the current attractiveness of emerging markets in terms of valuation?
Yeah, certainly when you look at I guess forward to PE ratios and price to book. If you look at them relative to developed markets, they are quite compelling. I guess the question is, what could be the catalyst for driving further outperformance? And it certainly comes back to the macro environment. So if you do see, say, further USD weakness, if there is a further, I guess, deterioration or increase in the fears of stagflation, that could be a catalyst for emerging markets. So that's something, I guess, a key reference point to watch.
Oh, thank you. So those are the questions we've had. Any further comments from yourself, Cameron?
Yeah, I think my broad sort of observation is that certainly I guess we're in uncharted territory in terms of where I guess tariffs and the like are going to unfold. And I think a key reference point is certainly looking at the experience during the 2018-2019 US-China trade wars. Now, that did last 18 months, and there were periods during that time where I guess there was a 90-day pause, and we did see that, I guess, unwind. So certainly we've seen a bit of, I guess, confidence come back to the markets, and certainly a key area to watch is how those, I guess, tariff discussions unfold. But having said that, there are positive signs coming out of, say, we did see, a UK deal announced, which is positive. The US-China dynamic seems to have, I guess, alleviated for now. And the key topic at the moment is certainly how the European Union discussions are going relative to the US. And they seem to be heading in the right direction, but again, that could change quite quickly.
And comments from our friend President Trump is definitely is not necessarily helpful in any changes as tuned between sort of Saturday and Monday. So whereas he was saying that we'll put extra tariffs on the EU, now he's saying there'll be another 90-day pause so that proper negotiations can occur. So anything could happen, but the more that the negotiations become effective or are effective, then the happier the market will be. The uncertainty has been unprecedented, as you're aware, and when you look at that April, second, third days, the market down 10.4%. There's only been 3 times since the Second World War that it's been more than that, and that was the GFC. Black Monday 1987 and also the start of COVID. So this is uncharted territory, as you've said, and it's interesting as to what people are doing and what people are looking at. But the idea of trading ETFs in terms of alternative things like emerging markets and gold, and then looking at quality investing, it is definitely something that people should be well aware of and thinking of in terms of a balanced portfolio. So we're very thankful for you for joining us today, Cameron. It's been a great pleasure having you here, and on behalf of Tiger Brokers and all our clients, I'd like to very much thank you for your time and efforts, and we look forward to our clients investing into some of the products you've talked about here. Definitely from a balanced portfolio point of view, it's a necessary thing to do. Particularly from we had a question saying about a younger investor. Younger investors have got longer terms to invest, so look at alternatives, but also diversify into things that you like. But don't shy away when the market is volatile. Don't sell. Hold on. Sit on your hands. You've seen the market drop 12 or 13% and then recover by 20%. So, long-term investing is definitely a goal, and the ETFs that we've talked about today are definitely a decent way of doing that. And so investors should be looking at these sorts of investments going forward. So thank you very much for your time, and great pleasure having you here, as I said. Thank you, Cameron.
Thank you for the opportunity, and great to speak with you, Greg.
Thank you. All the best. Thank you.